Welcome back to Iron Financial. This is the channel where we help you forge a stronger portfolio and cut right through the market noise and weakness. Today, we're putting Sprouts Farmers Market under the microscope, and this one is a real head-scratcher. On one hand, the company just posted a set of financials for 2025 that look like they're carved out of granite, an absolute fortress. But on the other hand, the stock is getting hammered because their guidance for the year ahead, well, it suggests there are some deep, serious cracks forming in that very foundation. So the billion-dollar question for your capital is this. Is Sprouts a solid structure built to last for the long haul, or is it a building that's about to undergo a serious, painful stress test? Let's get into it.
So the core conflict here, the thing that's making this stock so volatile, is actually pretty simple. The company just finished this phenomenal, once-in-a-decade kind of run in fiscal 2025. I mean, the engine was firing on every single cylinder. But when you look at the road ahead, the map they've laid out for 2026, it looks less like an open highway and more like a five-car pileup.
Exactly. And you know the market, it couldn't care less about the miles you've already driven. It only cares about the road ahead, right? After a run-up like Sprouts has had, investors are on hair-trigger alert for the first sign of a slowdown. The market is smelling smoke. And the question we have to ask is this just a little bit of friction from lapping an amazing year, or is the whole engine about to seize up and blow? Are we looking at the first real signs of a structural weakness in the whole Sprouts growth story?
You hit the nail on the head. And to really understand the potential for any future weakness, you first have to respect the sheer brute strength of the current structure. You just have to. So let's start with that foundation, the undeniable, absolute blowout results from fiscal 2025. Look, you don't get a stock chart that looks like a rocket ship without building something truly impressive. These numbers are the bedrock of the entire bull case.
All right, let's get into the guts of this thing. The first pillar holding this whole structure up is top-line growth. Full-year net sales for 2025 exploded by 14%, hitting a massive $8.8 billion. Now, you got to understand, in the grocery business, which is a low-margin, high-volume slugfest, a 14% jump isn't just growth. That's a land grab. They're not just growing their own pie, they're actively taking huge slices from the legacy players, the Krogers and the Safeways of the world. That one number alone tells you that their strategy in 2025 was firing perfectly.
Now here's where it gets really interesting. Let's look under the hood of that 14% sales growth, because this is the metric that separates real organic strength from just manufactured growth. Comparable store sales, we call them comps, were up a massive 7.3% for the full year. So think about it like this. Are they just growing by building more restaurants, or are the restaurants they already have getting more and more popular every single day? This number proves it's the latter. It means the existing stores, the core of the business, are selling way more stuff. They are not just growing by slapping up new locations, the foundational stores themselves are getting stronger, more productive. That is the sign of a truly healthy core operation and a brand that has some serious power.
And this is the payoff. This is where the rubber meets the road. When you combine that kind of powerful top-line growth with real operational efficiency, you get an absolute explosion on the bottom line. Full-year diluted earnings per share grew a staggering 42% year-over-year. It leaped from $3.75 to $5.31. This isn't just a little improvement. That is a quantum leap in profitability. For every single share of this company you own, it is now generating 42% more profit. That is the kind of performance that puts jet fuel in a portfolio. The profit engine was absolutely roaring.
And the strength isn't just in one place, it's everywhere. It is broad-based. Just look at the scorecard. Net income up 38%. Gross margin expanded by 70 basis points to almost 39%, which is just unheard of in the grocery sector. They opened 37 new stores, expanding their physical footprint. E-commerce is chugging along. And get this, their own private label Sprouts brand is now a $2 billion business all by itself. Every single pillar of this fortress looks like it's made of solid granite. Okay, I'll give you that. 2025 was a monument. It was incredible. But a fortress is only as strong as its ability to withstand a future siege, not a past one. This feels like a victory lap, but I'm really worried it's a victory lap at the top of a cliff. I mean, is there anywhere to go from here but down? Did they just pull forward 3 years of growth into one spectacular, completely unrepeatable year?
And that brings us to the part of the story that the market is actually trading on right now. Because you're right, the past performance was a fortress. But the forecast for 2026, it feels like a warning from the engineers that there is some serious seismic cracks starting to show up. We all know the market is a forward-looking machine, and the guidance management just put out is jarring. It's a completely different story from the one they just finished telling us. Just look at this table. Seriously, park it here for a second. This is the tale of two completely different companies. Comp sales growth, that beautiful engine you were just praising, goes from a positive 7.3% to a range of -1 to positive 1%. That is not a slowdown. That is hitting a brick wall at 100 miles an hour. And it gets worse. In the immediate term, Q1 of 2026, they're guiding to -3 to -1%. So the growth is already gone. It's already negative. Net sales growth drops from that incredible 14% to a range of 4.5 to 6.5%. And that 42% EPS grower for 2026, it's guided to be almost completely flat. When a high-growth company puts out numbers like these, it is like a record scratch at a party. Everyone just stops and stares. This isn't a small crack in the wall. This is a potential structural failure in the entire growth story.
And here's the official reason, from the CFO, Curtis Valentine. Strong prior year comparisons and a dynamic macro environment. Okay, fine. Lapping a huge year is always going to be tough. We get that. But is that a legitimate reason for growth to fall off a cliff like this? To me, dynamic macro environment is just corporate speak for we're losing our price-sensitive customers and we really don't want to admit it. Is that what's actually happening here? It just feels like an excuse for something deeper and more fundamental that's breaking inside the business.
And get this, the CEO, Jack Sinclair, he basically admits it right here. However, we are not happy with how the year finished as our comp momentum slowed. This tells you the problem didn't just pop up out of nowhere in the 2026 guidance. The cracks were already starting to show at the tail end of 2025. The engine was already sputtering as they were crossing the finish line. He is telling you himself that the foundation was already showing signs of stress before the year was even over. And that, to me, is a massive red flag.
I hear the skepticism, I do, and it's completely warranted based on that guidance. But a shaky forecast doesn't mean the entire structure is unsound. It just means we need to look closer at the architectural blueprint. Any good builder anticipates stress on their structure. The real question is whether the long-term design is durable enough to actually handle it. So let's shift focus from the short-term forecast and look at the company's long-term strategy, the blueprint they've been building on for years.
So here's the crucial point. This isn't a company that's just riding a wave and hoping for the best. They have a deliberate four-pillar strategy. First, win with their specific target customer. This means they're not trying to go head-to-head with Walmart on price. They are laser-focused on creating a premium experience. Second, expand their physical footprint, but with a de-risked store format, meaning they're trying to grow smarter, not just bigger. Third, build out their own advantage supply chain to get an edge on freshness and quality. And fourth, deepen that customer engagement using loyalty and data, trying to turn casual shoppers into die-hard fans. This is a holistic, long-term plan for a durable structure.
Now let's just drill down on Pillar 1 for a second to see how this is supposed to work. Sprouts isn't a generic grocery store trying to be everything to everyone. No, they are laser-focused on two groups, health enthusiasts and selective shoppers. The entire store experience, from the moment you walk in, is designed around fresh produce and an innovative, curated assortment of products. You are not going to find 50 different kinds of ketchup at Sprouts. What you will find is a curated selection of unique, high-quality products that you just can't get anywhere else. That is their moat. They're not competing on price, they're competing on experience and curation for a high-value customer who is theoretically less sensitive to economic swings. But is it working? This quote from the CFO seems to directly contradict Pillar 4 of your beautiful blueprint. He says the challenge is particularly with our lower engaged customers who are visiting less often and purchasing fewer items. So, if your whole strategy is to deepen customer engagement but your less engaged customers are fleeing the scene, that sounds like a fundamental flaw in the plan. Are they getting priced out by inflation? Are they just trading down to regular grocery stores for their basics? You can't build a national chain on just a small hardcore base of fanatics. The blueprint might look great on paper, but this quote suggests it is not working in the real world for a pretty significant chunk of their customer base.
You're right. That customer engagement piece is a legitimate concern, and it's something they absolutely have to fix. But a crack in one wall doesn't mean the whole building is coming down, especially when the foundation is made of pure steel. And that's exactly what we see when we look at Sprouts' balance sheet. Forget the operating hiccups for a second and just look at the financial core of this company. This company is built to withstand not just headwinds, but hurricanes.
Let's just start with this number, 0. That is the balance that Sprouts had on its $600 million revolving credit facility at the end of 2025. Now, a credit facility is basically a massive corporate credit card. Many companies, especially in retail, are drowning in debt. They're constantly borrowing just to keep the lights on. Sprouts is the complete opposite. To have a $600 million line of credit and to not have touched a single dollar of it, that speaks to immense financial discipline and incredibly powerful internal cash generation. They are a financial fortress.
And this just illustrates the point perfectly. They are doing the heavy lifting themselves. They opened 37 new stores last year. That cost hundreds of millions of dollars in capital. And they did it all while taking on zero revolving debt. They are funding their entire expansion from the cash that their existing stores are spitting out. This is the absolute definition of a self-sustaining growth model. It means they're not watering down shareholder value by issuing more stock, and they're not beholden to the whims of bankers and creditors. They are in complete control of their own destiny.
So, the crucial question is, where is all that cash going? They generated a massive $716 million in cash from operations in 2025 alone. They ended the year with over $250 million in cash just sitting on the books. And after funding all of their growth, they still had enough left over to buy back nearly $500 million of their own stock. And now they've authorized another $1 billion buyback program and plan to use at least $300 million of it this year. This is not a company that's struggling. This is a cash-generating machine. Okay, the balance sheet is pristine. I'll give you that. But are these massive share buybacks a sign of real confidence? Or are they a way to prop up the stock price now that organic growth is hitting a wall? It kind of feels like financial engineering to mask a fundamental problem with the business's momentum. Are they buying back shares because it's truly the best use of capital? Or is it because they just can't find any better ways to grow?
Okay, so that brings us to the final showdown, the verdict. We've laid out both sides. On one hand, you have the absolute fortress performance of 2025 and a balance sheet that's made of solid steel. On the other hand, you have these deep, concerning cracks showing up in the 2026 forecast and some legitimate questions about their customer engagement strategy. So, for your portfolio, is this an opportunity to buy a best-in-class operator during a temporary panic, or is it a trap where the market is correctly sniffing out a permanent slowdown?
All right, let's break it down one last time. My bull case is simple. You're betting on a proven winner with a rock-solid financial foundation. That monumental 2025 growth was not a fluke. It was proof that the model works at scale. The balance sheet is a fortress, and that gives them the firepower to weather any storm and keep rewarding shareholders. This isn't a speculative gamble. It's an investment in a quality company during a period of what I believe is temporary fear.
And my bear case is that you're trying to catch a falling knife. The market is screaming at you that the party's over, and you're ignoring the warnings at your own peril. That 2026 guidance is an alarm bell you simply cannot ignore. The CFO's own words confirm they have real customer engagement issues, which attacks the very heart of their whole strategy. You're buying into a story of decelerating growth at what could very well be the absolute peak, and that feels less like a solid foundation and a lot more like a trapdoor.
And really, that's the bottom line. As you can see from this chart, Sprouts stock has been building skyward, just blowing past the broader market. But the analysis we've just gone through shows this clear, undeniable conflict between its past strength and its future uncertainty. Forging a stronger portfolio means knowing when to build and when to stand back and wait for the dust to settle. The billion-dollar question for you is, which time is it for Sprouts? Thanks for watching Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.